Good Wednesday morning, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, where options trade 24/7, 365. Dimitri Pragmatic. How you doing, D?
Good morning, Will. How are you?
It would be interesting if options did trade 24/7, 365, wouldn't it?
I think that eventually you will.
You think?
I think so, yes. I think
Certainly enough of it is done algorithmically by the firms making markets that
yeah,
almost no reason to turn it off, right?
Yeah, I think that eventually that it may go there. At least during the weekdays. I do think that during the weekdays we're going to have a lot more trading, in like regular hours trading, but it's going to be expanded. And I think they're starting to do that, I believe, right now with the indexes. So the indexes may be already trading on much longer hours, even in the options. So eventually I think that we will go there.
Very cool.
Yep.
You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind that Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. With that, let me share my screen. And while I'm doing it, if anyone there is joining us for the first time, Will and I do these shows in the morning to help answer questions that you may have about the Market Chameleon tools, the data or analytics. If you want to come on a show and ask your question live, we have a link that links you to Zoom. It takes you over to Zoom. When you get into the Zoom, following that link, there's a button at the bottom of your screen. It says raise your hand. If you click on it, then you could ask your question live. If you prefer to type your question in, you can do that on the live chat on YouTube. Will's watching it. He'll read back those questions to me. While we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report, see if we could get some insights on the pre-market hours. Then I'll take any questions we have. If we don't have any questions, I'll just kind of continue on some of the conversations we've been having from previous shows, or default to some questions that I get through email. So a lot of you just prefer to send questions on email. And if I see questions that I feel like are, common questions or that I get a lot, I'll try to talk about those. So let's start out with the pre-market report. And these are stocks. They're trading in the pre-market hours. If I scroll down over here, there are three tables in here. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I'm going to slide down a little bit, and I see 60 stocks made our percentage gainers list, 116 on the decliners. So from this perspective right now, we look like we're setting up for a bearish bias at the open. And if we look at this list, we do see a lot of them on here are small cap stocks. Here's the market caps here. A lot of them are small cap stocks. There could be ETFs in there. We'll have leveraged products. You can see over here, closed-end funds, preferred stocks, lots of different securities trading. If they're listed on the major U.S. exchange and they're trading in pre-market hours and meets our thresholds, it can make this list. So we want to narrow down this list to a smaller group of stocks to analyze. And to do that, we could use the filters here. So we've got a bunch of filters to narrow this down. I'm going to use this one, an ETF. Click on it. You get a drop down with a list of ETFs to select from. Let's choose that first one, SPY. That's the S&P 500 ETF, the broad-based ETF. And when we click on it, the list below will get filtered by stocks that are holdings in the SPY ETF. And you could do that for stocks in your watch list by doing it from here if you save the watch list. But let's stay on the SPY. So here we have the S&P 500 constituents, and here we do see 3 made our percentage gainers list, 22 in the decliners. So from this perspective, right now, we look like we're set up for a bearish bias at the open. And, we had like I think, what do we have, like a 1% sell-off yesterday. So a little bit of a sell-off from those, high prices for the year. Let me see if, are there any questions? If not, I'll probably just move on.
Nothing has popped up yet.
Okay. So we did have a question left over yesterday. Let me see here. We had a question left over yesterday, and it is kind of a question that pops up, I feel like, frequently, and it has to do with if I have a position, and the position goes against me, let's say a credit put spread, when should I close out of it? Like, how do I manage that risk if it goes?
Actually, it was the question. I mean, we get both questions, but the question was from the other side. Sarush was asking when he takes his profit, but it's the same, it's two sides of the same coin, right?
Right. So when do I take a profit, or when do I take a loss? And I want to say, there are a lot of factors and variables that go into risk management. And there are teams that focus, exclusively on risk management. You'll have traders doing trades that they've evaluated, think they're good, but you'll even have another team trying to focus on the risk management, even telling the traders, you gotta reduce this, or do this, you got too much exposure here. So there are a lot of variables. There's no like simple general rule to risk management, because you wouldn't even have entire teams of risk managers, right? Like, risk management is an entire field, you could say, where you have experts analyzing risk all the time. And if there's a general rule, you could just follow the general. There wouldn't be no need for it. So there are lots of different variables. There's lots of different situations as far as risk management goes. And I think it's a very bad idea to give somebody any type of general rule, like the ones that I hear, because to me, it doesn't sound even like risk management. So, one of the things, and because we get these questions, and I've been telling you guys, we are trying to integrate with some brokers, with interactive brokers and TradeStation. And when we contact them and we talk to them, we told them, that our initial product that we want to create is allowing people to link their accounts so we could run it through a risk analysis. And we want to try to simplify that and kind of show you, what, when you evaluate risk, how it may look. Okay. Because one thing is, I think people, when you say that, then you're not really aware of your risk at any given time. And it's important to monitor your risk, in real time, but monitor your risk as the markets move and so forth. So your risk isn't the risk that you have on. Okay. Risk you have on, it's not dictated by your previous profits or losses. Your risk at this moment is your risk. Okay. And that's how you'd start to look at it. Like, what is my risk now and how do I manage it? And what do I want to do from this point? So when you're looking at your risk, it's not what happened up to this, is what do I have? What type of risk do I have at this time? And I did a sloppy kind of screenshot. I was trying to mock something up, in this morning, and I took a sloppy screenshot because as we're building these tools, they don't look that nice because we're moving lots of files around. So whenever you're integrating, especially with a third party, it's just you're moving files around, trying to always validate your data. So, bear with me, but I wanted to show you. Let me see if I could bring one up. So can you guys see that? Is that too small? Let me see if can I zoom this? Can you guys see that or no?
Let us know if you can see that, everybody.
Let me see if I can make it bigger. Can you see that, Will?
That's bigger now. Yep.
All right. So I wanted to show you something like what a risk might look like. I didn't have a lot of time to do, but you could see here, like I have this is one way to start looking at your overall position. So what you'll do is you'll take your position in, let's say, SPY, and you're going to aggregate it, all your options, your stock, all that, and say, what is my risk right now in SPY? So you'll start out at, if the stock just stays here right now and nothing changes, then nothing changes, I'm breaking even, right? At this moment. If the stock, then you could shock and say, if implied vols go down 10%, what do I stand to lose? If they go up 10%, what do I stand to make? What if the stock moves to 5-10% from here? What if it moves down to 5-10% from here? What is my risk to the downside? What is my risk to the upside? By the same thing, these are your P&Ls. What type of risk do I have in my portfolio? You have your delta risk, your gamma, your vega. How does that change as the stock moves up, as the stock moves down? So that's where you start beginning. What do I do with my risk? Do I have too much risk on? Do I have things that are risky with vega or gamma that I want to take off? Where are the current prices? But you notice that on this chart, on this risk graph, I don't reference if I lost or made 5 days from 5 days ago to today, right? This doesn't factor into what should I do with my risk right now, right? Because that already happened. It doesn't impact my current. Even if you lost 50%, right, of what you wanted to lose, you're looking at your risk at this moment, and then you got to decide, what do I want to do from this moment, irrelevant of what happened, if it gained or lost, right? That's already happened. That's inside. Either your capital went up or it went down, but now you're looking at what type of risk do I have and do I want it? Do I agree with it? Like, so if I'm looking at this and saying, hey, you know what, from here, it looks like, if vols go up, I'm going to make money. And maybe that's my outlook, that vols are low and I want to have that risk. And if the market goes down, it looks like that my portfolio is going to make. If it goes up, I'm going to lose. So if my outlook that vols are low, right? Vols are low, and there's more downside risk because maybe you feel like the market, whatever it got up to a high point. There's more risk to the downside and the upside if you factor that in. So to the downside, it looks to me here like, I'm gaining to the upside, and yes, I'm gaining to the downside. This is actually one of my that I just took. I'm gaining to the downside and I'm losing to the upside, but I got a 3-to-1 ratio here, that I'm losing here. If it goes up $5,000, making here 16. And I think I'm more worried about this outlook. I think that this is a more likely scenario with vols cheap, and there's more risk to the downside. Do I agree with this, right? So it doesn't matter what I did up to now. I'm not even looking at that, because if I agree with this and I want it on, there's no reason for me to take it off, even if I lost $1,000 going up into leading up to here, right? I could have lost $2,000 leading up to here. But if I'm looking at my risk profile and I think like, well, I have a position on which agrees with my outlook, it looks reasonable, I'm fine with my I'm fine with my upside risk. I'm fine even if volatility comes in and it goes up. I could handle that. And I like the risk reward. Then there's no reason for me to take off the risk, even if it up to this point I lost, going into today. All right. So I think the point I'm trying to make is when you're trying to assess risk, trying to manage risk, there's no rule that, to follow, that if I put on this, credit spread or whatever, if it's down 50%, I have to get out of it and stop. You're assessing your portfolio as you're going and as your outlook is changing. And as you're looking at the markets, where are the opportunities, right? And what do I want to add into my inventory? What do I want to take out into my inventory? Now, yeah, I could reduce some of this, maybe, hey, I could reduce my upside. Maybe there's a chance that if I think that all of a sudden there might be a really good chance we might pop, maybe, if I feel like they're gonna do a deal and raise the debt ceiling. And if I think that there's a big upside, I might start reducing some of it. Maybe I'll buy back a call or something to, get this a little bit lower. But the idea is I'm monitoring this and watching the risk. And this is a different analysis than my day trades and profit and loss. That is a different analysis. So if you lost, then we're going to go and analyze the day trades. So what did we do wrong? Like, why did we lose this much? What were we thinking? What were we doing? Where did we err? And that will be separate from your risk management, right? So risk management, you're looking at your risk at this moment. Do you agree with it? Is this what you want? And where do you want to reduce it? Maybe you want to increase it some places, but that's how you manage your portfolio risk. As far as your profits and losses, we have to do a different analysis on it, right? Then we got to go back and say, well, what, did our model getting into it did we err? Did we not consider factors in there? Was our execution bad, right? Did we get a bad execution, and did that play into it? Do we have to watch and improve that? So when your profits and losses, those trades will get a different analysis than your current risk. All right, so hold on, let me try to get out of that. Does that help everybody? And when, I'll try to talk more about it as I know I've been telling you guys, we've been trying to integrate, but it's harder than, it's easier said than done, because whenever you're dealing with third-party systems, it's slower, and you have to learn and work out things that you didn't expect. There's exceptions, but I do think that risk management, it's very important. And you will see that there's going to be a assessment of risk prior to entering in a trade, right? So you got to be able to understand the risk, explain it, price it, do a complete evaluation prior to getting in, and then there's an analysis post trade, of continuously watching that risk, and rehedging it or trading around it. So I think that the most important part that I did want to mention is that it's dangerous to give some kind of general rule to risk, right? Because risk doesn't work that way. There's lots of different factors that play into it. There are too many variables, and you would have to become, more of an expert from experience and education and knowledge than applying any type of simple, rule of thumb. But if I had to give some, rule of thumb, is that don't overtrade, and don't concentrate too much risk, and don't, put too much, the rule of thumb is don't go into a trade, putting all your baskets in there and going all in. That's enough.
All your eggs in one basket.
All your eggs in one basket.
I mean, rule of that is a good rule of thumb.
That would be a good rule.
1% to 2% of your portfolio should never be in more than one trade, right? I mean,
yeah, because it's like, think of it as, if you're in a business of running a grocery store or supermarket, you're not going to go out there and say, oh wow, the price of butter right now is really good, and it's so good that I'm going to put all my capital into buying butter, clear out all my shelves, and just put butter out there because the price is so good that I think I could just, scalp out of it. And that wouldn't make sense, right? That wouldn't make sense, because you might sell some butter, but then, that's not the way you run a supermarket. That's not the way you manage your inventory, and that's not the way, you run a business. So you shouldn't apply the same thing to trading, where you sit there and I mean, I'm almost in shock, that I hear people do. They'll open an account somewhere and, fund it with, X amount. And then they'll look at an Amazon call and say, 80% of my X amount is going into this Amazon call. And, that it's gambling, you could gamble, it's your money, but that's not smart trading, right? They would not let you do that in a bank, right? They would not let you go in a bank and say, you can't come up to, Jamie Dimon and say, I'm gonna take 80% of, our risk capital, and I'm gonna buy an Amazon call. Like, would that make, do you feel like that would fly with any trading operations? So people do that. And part of it is, I think that there's a resistance to taking time to learn things and to get experience. There's this need for, instant gratification of, I need to do a trade, or I'm going to miss out, right? I'm going to miss out if I'm not in the markets. And that creates lots of problems, because it usually does not, I don't know everybody's situation, but usually I don't think that works out. It's not gonna have a great result.
We did have a question pop up from Vlad.
Yeah.
He's like, I have a question on the topic. Will we be able to download our holdings into MC so that we can analyze our portfolio risk? Also, will there be integration at some point? And I think TOS is Thinkorswim. I could be wrong.
Yeah.
And Tasty in the future. Tasty, I guess, is Tasty Works.
Yep. No, thank you for the question. That's a good. When we decided on, trying to help with a risk management tool, there are a couple options. One is just to let you enter in positions manually, which is not an efficient way. So yes. So when we talk to our contacts at the brokerage firms, we, you know, when we link them, there's going to be a manual process, a setup process. It's like a one-time process. It's not, you got to go through steps because there's security and stuff. So, we'll put instructions, but once you go through it, then yes, your positions will be imported, right? You get permission, you import it. So your positions will be in there. It'll be an automated import. So once you log in, you will be able to see your positions. And the first two brokers that we're trying to do it with is Interactive Brokers, because we have a good relationship with them and we already know people. We know people there. We've worked in the past years ago with people who worked there. So we with Interactive Brokers and TradeStation, because we have contacts there, and it's easier to work with people when you have already, the support. As far as the other brokerage firms go, once we feel that that we developed it enough and it's solid, and people, we work out the features and how it helps, then we'll approach other brokers that are customers request, because certainly we have customers that have accounts in many across different brokerage firms. It's not just Interactive Broking or TradeStation. Like some of those you mentioned, a lot of people have there. So we will probably try to contact them once we have the features in place and that we feel it's stable enough.
Yeah, that's awesome.
Thank you for the question. Yeah. And I really appreciate the questions, and you guys, the fact these are important things, right? These are important things to talk about. It's critical. I wish sometimes I feel, maybe people are frustrated because there's no simple answer. If I had the simple answer, I'd give it to you guys right away. If I knew the simple answer, but there are things that I know they're not simple. They're not simple for a reason, and it's important to understand, that there are going to be different factors involved that you need to start considering and taking into consideration, in your overall trading system. All right, so I guess we're right up at 9:30, Will.
Right up against the half hour, the almost opening bell. Everyone, thanks for joining. Remember, thumbs up for Market Chameleon. Subscribe below. Thanks everyone for joining. Great job, D. You have a great trading day.
Thanks everyone. Stay safe out there. Have a great trading day, and hope to see you